Hello, Michelle Kilman, your dependable lender with Summit Funding. First of all, I need to say, go Avalanche! Today is game 5, and we're hoping it is the last game of the Stanley Cup Finals. They are playing at home in Denver, so the town is just pumped up. I love hockey. All right, so now that that's said, we're going to talk about temporary interest rate buy downs today. So, what is a temporary interest rate buy down? It's a temporary reduction in the interest rate that the borrowers pay during the first few years of their mortgage. So it can be 1% all the way up to 3%. Of a difference between what they qualify for and what they're going to be paying. Okay, and so it'll be cheaper, 1 to 3% cheaper. And the savings for that rate is going to correspond with the amount of years. So if they just do the 1% temporary interest rate buy down, it would last for 1 year. If they do the 2%, it's going to last for 2 years. And if they do the 3%, it's going to last for 3 years. And so how it actually works though is so if they do the 3-year one, they're gonna get 3% off the very first year they're making payments. So let's say they get qualified at a 6% interest rate. The very first year, they're gonna be paying 3% interest payment. Then the second year, they're gonna pay a 2% interest, less interest rate. So it would be 4%. And then year 3, they would pay 1% less interest rate than they were qualified for, which would be at 5%. And then year 4, they would start making payments with the 6% interest rate that they were qualified at. So that's kind of how it works. The cost of the buy down is funded by the seller, the builder, or the borrower. And then the lump sum is put into an account, and that account will cover the difference between the note rate and the loan rate until the time is up. So depending on whatever the time frame is. I did run just a general idea of what this temporary interest rate buy down costs. And for a $600,000 house, let's say and they do the 1%, it costs about $6,000 to $9,000. For a $600,000 house with the 2% buy down, it would cost between 12 and 15%. And for the 3% buy down would be $26,000. And that's going to vary, that's going to be dependent upon the loan. I just wanted to give you a general idea of what the tier difference is between those temporary interest rate buy downs. So that is not a quoted amount. It's just so you can kind of get an idea in your head of what those different tiers of interest rate buy down would cost the seller, the borrower, or the builder. This product is only available for 30-year fixed rate loans. So we cannot apply this to an adjustable rate mortgage. It is not available. Then FHA, Fannie Mae, and Freddie Mac all allow for this to be used for a primary residence up to 4 units. So they can use 1 unit as their primary residence, rent out 3, that is fine. And then obviously, anything lower than that, single houses, whatever, is also acceptable. They also allow for secondary homes to use this. So that is fine. The only thing they do not allow is investment properties. So that is not, we cannot use that. For VA loans, they allow for primary residence occupancy only. So we cannot do secondary homes with a VA loan, and we cannot do investment properties with a VA loan either. So no investment properties at all can use this temporary interest rate buy down. And there's also no manufactured homes. I forgot to mention that. So no manufactured homes can use this either. The borrower is going to be qualified at the note rate, which would be the interest rate that they're qualified for today. And that means that they would be able to make the payment when that interest rate goes to where it needs to go, where it goes to the rate that it is today. Make sure that they qualify at that so that we make sure that they are going to be able to make their payments when it goes up to that. Okay, so we don't qualify them at the discounted rate. They are qualified for the highest rate possible, because we want to make sure people are staying in their homes. That's definitely our number one priority. There are some programs that are not able to use the temporary interest rate buy down, and those are Home Ready, Home Style, and Home Possible. So like the first time home buyer programs that already have discounted rates and discounts available to borrowers are not participating in this. 203K loans cannot use this, so the renovation loans cannot do it. State housing programs like CHAFA, they cannot use this temporary interest rate buy down, and jumbo loans also cannot use this temporary interest rate buy down. So I hope that gives you some general idea of what a temporary interest rate buy down is, and now you are more educated about it. If you have any more questions, please feel free to message me or comment down below, and I will answer. Other than that, I hope you guys have a good rest of your weekend, or good weekend in general. I don't know why I said rest, but I will talk to you again soon. Enjoy watching the Stanley Cup. Bye-bye.